Hello, chart watchers, and welcome to this Tuesday, October 30th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's take a look at today's action so far. The Dow Jones Industrial Average trying to rebound up 187 points. The S&P 500 up 19.5. The NASDAQ up 64 points. Russell 2000 actually outperforming the last 4 or 5 days, as you can see, trying to hang in there and hold the losses to a minimum. Up 23 points today, back to 1,500 on the Russell 2000. 10-year Treasury yield currently up about 2 basis points, still kind of hovering right around that 3.10, 3.11% area. Volatility, which has been just off the charts the past few days, currently down just a little over 1%, back to 24.37. Leading to the upside today, we got XLC, Communication Services. That's welcome relief, up more than 2%. Real estate, though, in the second spot, XLRE, a defensive group, breaking out of this reversing head and shoulder pattern, bottoming head and shoulder pattern. So that looks pretty bullish there for the XLRE. XLE up 71 cents. You know, I noticed as I was going through here today, I believe it's 16 days in a row that the XLE has put in a lower high. So today it is still in that same pattern. It'll be interesting to see when we finally break this downtrend if the XLE can get some gains to stick. The XLU utility is the weakest group in the market today, but that's not too unusual given that the market is up. This is a group that has been outperforming in October, and that is a concern for the market in the near term. As far as earnings news goes, we had Under Armour coming out with a huge beat, raising guidance. And Under Armour, you can see up more than 25% today. Very strong day for Under Armour. And on the flip side, we got another bad report out of GE. They came up short on their expectations in terms of earnings. And they also cut their dividend by 92% down to 1 penny a share. Not good news for GE. Erin, I think ever since we've been doing this show, I think GE's been down about 92% of the days.
I know, it's so beat down. I saw the report today and I shook my head. I thought, oh goodness, they're going to get hit again.
So, wow. You know, this is still a $100 billion company.
Yeah, I mean, I know you keep thinking, well, how low can that stock go? Because it is such a large cap company. I don't know. What are you thinking? Are we going to find a bottom eventually here?
I'm going to let somebody else find the bottom. I'm not going to try and find the bottom. When you think about it, I mean, if it becomes a $50 billion company, it's going to be $5 a share. I mean, it's,
yeah.
I don't, you know, when a company has kind of lost all its momentum, they gave up on their former CEO after a year, and now they got the new guy in trying to see what he can do. And, you know, I mean, he's picking up the pieces of a shattered company right now. Not just in terms of their chart, but, you know, I mean, their business. I was looking at a little bit of their report today, and I saw that their healthcare area was flat. And I'm just thinking, how could healthcare be flat? I mean, healthcare has been the best area in the market over the last year. I mean, it just seems like they have nothing that's working for them right now.
Yeah, it's kind of yeah, I feel bad for them, but you know, I think you've talked about it before. It takes a long time for investors to forgive. So they haven't forgiven GE yet, that's for sure.
Well, I know when I was in public accounting, I actually had a client who I did some work for, and they had somebody come in from Xerox, one of the representatives, and we were talking about Xerox. This was back in the late 90s, probably early 2000s, and Xerox had taken such a big hit. And the representative for the company that was in there was saying that, you know, the really sad part is that a lot of the employees had their retirement in the stock. And I just hope that in today's day and age that we don't have the same kind of situation where you got a lot of folks at GE sitting there with a bunch of their stock as their, you know, retirement nest egg. But
no
anyway,
diversification.
Yeah.
I mean, yeah, that's dangerous. All right, well, upcoming schedule. We've got today, of course, you're going to be doing your November seasonality. Dr. Elder, Alexander Elder, will be with us tomorrow. Can't wait to talk to him. November 1st, on Thursday, I will be going over all the new monthly charts that will have just gone final. And then finally on Friday, Mary Ellen will be back for what's hot and what's not. Today, We've got, of course, the seasonality report after technical news. 10 and 10, our first symbol will be Target Corp, TGT. And we will finish off with a scooter report. I've got some interesting stocks to show you through the scooter reports. All right, Tom, technical news and headlines.
All right, well, we've got some economic reports out this morning. The August Case-Shiller home price index came out, rose 0.1%, exactly what the market was looking for. And then October consumer confidence came out at 10 a.m. this morning, 137.9 versus 136.3, so a little better than expected. And that has resulted in a 10-year Treasury yield, which has moved a little bit higher. We did get as low as about 3.06% back on Friday, but you can see we've made a move back up, now challenging the declining 20-day moving average. Now, for a while, really the past couple of months, we had a rising TNX, and the rising 20-day EMA was holding as support. Now we have a declining TNX, and that 20-day has rolled over. So if you're looking at the TNX thinking that, hey, we need some money rotating away from the Treasury market into equities, well, first thing technically we're going to need to see is a move back up through that 20-day EMA, which is currently sitting at about 3.13%. So something to keep in mind as we go forward. We got a big jobs report coming out on Friday. Of course, the ADP, I think ADP employment report will come out tomorrow, even though it's not November. I think maybe it comes out on Thursday. I'm not sure when it's going to come out, but I know the big one is that non-farm payrolls report, and that will be out on Friday morning, and everyone's going to be holding their breath given the way the market has been performing. All right, let's turn our attention to earnings. Earnings are beginning to pick up, and last night we had a couple of reports, nothing huge. Mondelez International, MDLZ, did beat expectations. KLA 10 core, maybe helping, hopefully putting in some support on the semiconductors, providing a decent report there, 2.46, $2.46 versus the $2.21 expected. And then this morning, you can see Pfizer came out with a great report, at least on their bottom line. They actually missed on revenues. We'll talk about that in a bit. MasterCard beat on their bottom line. Coke did the same. And of course, as Erin and I were just mentioning, another dismal report out of GE, posting 14 cents a share versus the 20 cents a share that was expected. Number of big reports, though, coming out after the bell. And the first one will be Facebook. That's going to be a big report. Obviously, everyone is waiting for. They had a debacle in their last earnings report, if you recall. Big gap down. I think the stock was down $45 at the open the last time Facebook reported. That was when they came out. They actually beat on the bottom line, but they threw Wall Street a curveball and said that they were lowering their margins going forward. I think their operating margins from 45% and 44% for the next 2 years. They lowered them down to 35%. And the market didn't like it much. And if you recall, let's take a look at that chart. It was not pretty. Here was the big gap down on Facebook from, I said $45. Maybe it wasn't quite that much, maybe 43, something like that. But anyway, it was up. It was trading at an all-time high. And the interesting part about this report, and I've mentioned this a few times, but analysts go out to these companies and they're talking to them up until, close to their reporting time, until it becomes, a quiet period where they're not allowed to talk about it. But normally analysts get a sense when a company is going to report something that drastically changes the valuation of a company. But you can see the way that Facebook was trading here, moving up to an all-time high in July, and the volume was picking up into that prior to the earnings report. So there were a lot of folks expecting a really good report from Facebook, and it was as if Facebook didn't tell anybody what was going on. And that usually is a problem in terms of confidence on Wall Street. And you can see Facebook has been declining since. I'm not sure what we're going to get out of Facebook. I wouldn't be surprised if they come up with a beat and we see maybe a little bit of a rally because the stock's been so, beaten down the past few months. I wouldn't be surprised if they come out with that second cockroach in the kitchen. Always say there's never just one cockroach in the kitchen. That's a big Wall Street adage. I wouldn't be surprised if the next one's spotted. And I think that one's coming at some point. I just don't know if it's going to be with earnings. But Facebook just not looking very good to me. I would be careful as we go into their earnings report tonight. I mean, it could go anywhere, as could any company with their earnings. But I just don't like what's been going on technically with their stock for some time now, really ever since that earnings report came out. Okay, let's take a look at some of these companies that did report, have already reported. MDLZ. MDLZ beat on the bottom line, missed on the top line, and did reaffirm their fiscal year 18 outlook. You can see we gapped up over the 20-day moving average, traded back down beneath it. We'll see whether or not we can hold that 20-day into the close. KLA 10 Core beat on the top line, beat on the bottom line, but in a very weak group. The stock did get some relief earlier, was up above $92, tested that declining 20-day moving average, so far backing off from it. Pfizer missed on their top line, beat on their bottom line, but they guided their revenues lower for fiscal year 18. A little bit of a surprise given the strength that we've seen on a relative basis over the past few months in Pfizer. A lot built into this report. I'd be watching maybe down around 41, maybe 40.5. This is where the last two bouts of selling found support. So as we move lower, you should probably watch those two areas. MasterCard beat on the top line, beat on the bottom line. Doesn't seem to matter, continuing to trade below its 20-day moving average, breaking down big volume on this distribution, and you can see the PPO weak as well. Coca-Cola beat on the top line, beat on the bottom line. They affirmed their fiscal year 18 guidance, and this one is continuing to perform well. Coke is in that more consumer staple area that is being favored right now, and I think with a earnings report that beat top and bottom lines, a lot of traders jumping in here. GE, I don't know if it can get a whole lot worse. I guess it can. But GE missed on their top line, $29.57 billion in revenue. The market expecting a little over $30 billion, 14 versus 20 cents bottom line. And as I mentioned, they cut their dividend 92%, all the way down to 1 penny a share. I'm sure they left it at a penny just so they could say that they have continually paid dividends for X number of years. But let's be honest, 1 penny. Not going to do a whole lot in terms of income investors getting excited there. Akamai, I'm going to talk about this company in seasonality a little bit later that loves the month of November and December, those 2 months. And with earnings, big gap up here. They beat top line, beat bottom line, and announced a $1.1 billion share repurchase agreement. Wing, not Win, Wing. Wing beat top line, beat bottom line, inline guidance. A lot was expected out of this company. And it's up 9 cents. Not really delivering a great report. It's just an okay report. I did want to mention last one, UAA. This is Under Armour. They crushed the bottom line, 25 cents versus 12. They beat top line, $1.44, $1.44 billion versus $1.42 billion. And they guided fiscal year 18 EPS higher. And I'm actually seeing, I think maybe we go out to a longer term chart on Under Armour. Looks to me like we had a left shoulder, neckline, head, right side of the neckline, right shoulder, and coming up. A move through 25, I think, would be very bullish for Under Armour, something to watch. All right, upgrades, downgrades. Erin, what do we have for today?
All right, let's go. We've got quite a few. I don't even know that I'll get through all of them, but we'll see what we can do. All right, well, we're going to start. We just talked about Akamai, so might as well bring that one up first. It was upgraded today, might have had something to do with that nice big gap up. SunTrust upgraded it from a hold to a buy. It has bopped up through that overhead resistance that I would be looking at from these lows, this zone, and then you also have these highs back here. So I see a little bit of a match there as far as the resistance line goes. And we did actually break out from that area. The 5-day EMA is just about ready to cross above that 20, and that would give us a short-term trend model buy signal. And then I've got a PMO buy signal. Granted, it arrived just because we did have this big gap up. You can see that the PMO was actually decelerating at the time yesterday. And now, of course, it's been yanked upward and into a buy signal. So when I see that kind of pop and energy, I would prefer to wait until it settles down. I get a little bit better feel for where it's going to go. But an oversold PMO buy signal is generally a good thing to see. Nordstrom. was upgraded today by Wedbush from a neutral to an outperform. And you can see it's bumping right up against overhead resistance at that high back in September. The PMO has given me a buy signal, and notice the difference. This is not a yank upward kind of a buy signal. This was in the making already, and now we're getting confirmation with that buy signal, and then throw in an upgrade, and we've got a over 6% move here. It's looking really good. I'd be watching for that breakout, but I think we're going to have to pull back just a little bit to that breakout point from that short-term resistance level where we saw the breakout. A lot of times you'll get those breakouts, and then you'll get a snapback or bounce back there, and that's when you'd want to get in. Generally, that's what you're looking for. Nvidia was also upgraded today by JP Morgan, neutral to overweight. It's barely, excuse me, had a difficult month, to say the least. This 4% move today is certainly good news, but as you can see in the thumbnail, we're still making lower highs, and that's continuing. That means to me that declining trend is still in force. And the PMO, it is decelerating here, and this was a good area to bounce off of, because it comes right there at that December 2017 low. So this is the place you'd want to see it bounce. But personally, I'd want to see it at least one or two higher highs rather than lower highs. Another upgrade was Warner Enterprises today. KeyBank upgraded it from a sector weight to an overweight. I went ahead and pulled this chart out to a 2-year chart because I was having difficulty finding really good support and resistance lines. I needed to see a little bit more history. And sure enough, I found these lows back here from 2017 and, of course, earlier in 2018. And you can see that we're now getting ready to pop up against that resistance. And I would look at it as a resistance level. I know we've been really chopping around this area, but at this point, now that we're trying to make that move back up, I would be looking at this level as very important to see that breakout. We had a fake out PMO bottom, and I don't trust this one just yet either. So we'll have to see if it can make it through that level at about $33. At that point, I think it could be an interesting play. All right, some downgrades for you. Actually, let me let you know a couple of other big name upgrades that happened today. We had SCHW came in, Schwab with an upgrade. Hershey, HSY had an upgrade. JetBlue came in with an upgrade today. And Old Dominion came in with an upgrade, ODFL. All right, let's look at these downgrades. Dillard's being our first one. Wedbush downgraded downgraded Dillard's from an outperform to a neutral. I liked this chart. This chart was probably one of the best ones that I saw of them. And on the downgrade, I think this is possibly a good purchase here. You've got the 5-day EMA crossing above the 20-day EMA. I've got a nice PMO buy signal to confirm, this rally that we had before. We got a downgrade today and it's pulling back the price, but I think that's a good thing to see it pulled back toward this area of support, short-term support from August and September. Get that pullback there, that might be the place to get back in and ride it up to that $80 level. All right, one more here. Let's look at E-Trade. Now, you heard that Schwab was upgraded. Well, E-Trade was actually downgraded today. Raymond James downgraded it from a strong buy to an outperform. So granted, it is a downgrade, but we're still looking at an outperform for E-Trade. I see some overhead resistance that's going to be a little bit of a problem, but a really nice PMO bottom. Again, with this one, I've seen some false ones, so I would want to wait a bit longer on this PMO and really make sure that momentum is in place and we get that breakout above 48. But I think a breakout above 48 and it is a downgrade, but a downgrade to outperform. So I think that still looks pretty good. LabCorp, Argus upgrade or downgraded this from a buy to a hold. I had to bring this chart out as well. And again, we're looking at these areas of overhead resistance at the lows from earlier in 2018. You see that on a lot of these charts. This one still looks ugly. PMO is setting new lows for the past year and a half. So I'm not liking this one very much at all. We don't have time for them, but United Airlines, Spirit, and let's see, Love, Southwest Airlines. All of those airlines were downgraded today, so just FYI. And Red Hat was actually downgraded by 2 separate agencies today, and I thought that was rather interesting because I know they had that big pop with IBM getting ready to buy them out. So, and I did look at the chart. Doesn't look like much happening there, not hurting it really. All right, that concludes the upgrades and downgrades. Whew, quite a few there. Tom, you ready for your seasonality report? I'm sure you are.
I am ready. It's time to take a look at November, and just keep in mind that seasonality is just telling us historical tendencies. These are not guarantees. I remember going through a month ago talking about all of the October seasonality, and much of it was bullish. Over the past 20 years, the S&P 500 had performed best in the month of October, and even going back, I think, to 1950, the S&P 500 had a pretty strong track record in October, averaging, I think the annualized return was over 11%, and yet you saw what just happened in October. So, I wouldn't say take it with a grain of salt. I think that there is a lot that you can glean from seasonality, but I just want to make sure that this isn't your primary tool used to trade or invest. I don't think that would be the right way to use seasonality. I use it personally just to confirm things that I'm seeing on charts and the technical conditions in the market. And so that's what I would suggest that you consider using it for. So having said all that, I'm just going to read a few things off here, and then we'll take a look at the number of charts in just a couple minutes. But from a monthly standpoint, the S&P 500 in the month of November has risen 46 times out of the last 68 years. So it's got a 46 win rate, 22 losing rate. And over those 67 years, the annualized return on the S&P 500 during November is 18.42%, which is more than double what the S&P generally earns throughout the year. The average is around 9%. So this being 18.42%, really about double what we would expect throughout the year. And that ranks November as the second best month of the year for the S&P 500. So there's a little clue for you in the poll, which we'll go over in just a little bit. The winner is not November. NASDAQ in November since 1971, it's gone up 32 times in the month of November. 15 times it has gone lower in the month of November. The average return, 19.86% in November, and that ranks third out of 12 months. And then the Russell 2000 small cap index since 1987 has risen 20 times. It has fallen 11 times, and it's averaged gaining 14.39%, which ranks November as the fourth best month of the year for the small cap Russell 2000 index. Now, within the month of November, there's no doubt, and we're in the middle of it right now, the October 28th to November 6th timeframe on the NASDAQ has produced annualized returns of 80.59%. That 10-day stretch, October 28th to November 6th, has produced an annualized return of 80.59%, dating back to 1971. If we go back to 1950 on the S&P 500, the October 28th to November 5th, so just a slight difference there, the 5th instead of the 6th, that 9-day period has produced an annualized return of 66.72% on the S&P 500. And keep in mind, again, the S&P 500 has an average annual return of 9% a year. So when we're talking about an annualized return in these 9 days on the S&P 500 of 66.72%, that is more than 7 times the average return. I mean, if every day was created equal throughout the year, then every day, this period would have an average annualized return of 9%. but it's 66.72%. Clearly a very bullish historical period. The Russell 2000 from October 28th to November 6th since 1987 has an annualized return of 76.50%. So the stock market loves this time of the year. We got off to a rough start yesterday. Today, so far, we've got market moving higher. Just know history is on the side of the bulls as we go through the next 8 or 9 days. All right. The balance of the month, S&P 500, and I didn't go through all of the other indices, but the S&P 500 from November 6th to November 20th. So after this bullish period ends, the next 2 weeks, the annualized return on the S&P 500 is minus 5.99%. So the middle of November tends to be more profit-taking, sideways consolidation. And then we get into the end of the year and we see bullishness return. The S&P 500 from November 21st to December 6th, the annualized return is 33.71%. And again, that's going back over the last 67, 68 years to 1950. 33.71% is more than 3 times that 9% average. So pretty bullish month overall in November. Little, complacent, little, sideways consolidating kind of a market in the middle of the month. But usually the beginning of November and the end of November are very strong. We'll see whether or not that holds up. Certainly the market or the bulls are hoping that we're going to see a really strong first week in November, given everything that we saw in October. But we'll have to wait and see. Okay, so let's take a look at some charts. I'm going to pull up some sectors that outperform or tend to outperform during the month of November. One is the XLB. Now, I have to be honest and say I'm not a big fan, even though from a seasonality perspective, the XLB tends to do pretty well. I mean, if we look back over the last 20 years, look at the average gains in November and December for the XLB, 2.8%, 2.5%. The big problem I have with the XLB right now is simply the dollar is in an uptrend, and I feel strongly that the dollar is going to continue to move higher, and that's going to create a headwind. It's been creating a headwind for the XLB, and I think it will continue to create a headwind. So, but still, the XLB, if we compare it to the S&P 500 over the last 20 years, you will see the outperformance, 1.6% and 1.3%. These 2 months are clearly the best 2 months for the XLB in terms of relative performance versus the benchmark S&P 500. So you do need to know that the materials tend to do well. I will also go over in just a couple minutes the industry group, which is steel, that tends to do extremely well at the end of the year. And that is one of the reasons why, the biggest reason why we do see outperformance in material. So we'll take a look at the steel industry group in just a minute. All right, how about the XLI? The XLI, this is industrials. Going back the last 20 years, industrials have outperformed the S&P 500 84% of Novembers and have averaged outperforming by 1.4%. So that's pretty strong relative strength that we tend to see from industrials, and it continues into December, where we see outperformance there as well. So both materials and industrials tend to perform really well versus the benchmark over the next 2 months. Next up, consumer discretionary or cyclicals. Last 20 years, you can see November outperforming by 0.9%, December outperforming the S&P by 0.6%. And keep in mind, again, this is relative performance. So if I get rid of that and I just show you absolute performance, you will see that the XLY average is going up 2.1% in November and 1.8% in December. All right, now let's take a look at the relative performance of technology. November tends to be pretty good. December, not so much. Here is November. And by the way, October, it tends to be the best month of the year for technology stocks. And that was not the case what we've seen. Unless we have a really big reversal today and tomorrow, that is not going to hold true in 2018. But anyhow, historically, over the last 2 decades, November has been relatively strong for technology, but December has historically been weak. And look at that The XLK has outperformed the benchmark S&P only 32% of December's going back the last 2 decades. So normally if you're looking for leadership, you don't want to look at technology in December. Okay, so what lags the S&P 500? Well, normally in November, the XLRE, this is real estate. Now, this is going back the last 18 years, but minus 1.2%. So it underperforms the S&P by 1.2 percentage points. December, though, is pretty strong. And you can see as we just go into the year before we get to December, just keeps drifting lower in terms of outperforming, the odds of outperforming. And you can see October was flat, November minus 1.2. So the XLRE's got some work to do. The XLU. Now, and keep in mind, too, that the S&P 500, because the information I gave you earlier, because the market tends to do really well in the month of November, you're going to typically see the defensive groups underperform. When the market's doing well, money rotates into aggressive areas and away from defensive. So here you can see XLU underperforms October, underperforms November and December. All 3 of those months tend to be bullish months, so it shouldn't be too surprising to see that is the historical norm. Finally, the financials tend to struggle a little bit in November. Last 5 years, though, by the way, we have seen outperformance in the XLF. But if you take those 5 out, and actually if we go back to 15 prior to those last 5, you can see November underperformance minus 1.9%, and it outperformed the S&P only 20% of November's over that 15-year period. So the last 5 years being stronger has actually improved the relative strength in the XLF. But still, the bigger picture is that the financials tend to underperform in the month of November. So let's talk about some of the industry groups. All right, I'm going to start with the steel, DJUSST, and I'm going to show you that relative to the XLB first. And you can see over the last 5 years, pretty strong November, but let's drag it all the way back. Let's go back over the last 19 years. Steel versus the XLB. Now, we already know the XLB is much stronger than the S&P 500. So steel relative to the XLB is one of the stronger areas within materials. So if we change this and just compare it to the S&P, we're going to see some massive outperformance. And not so much over the last 5 years. But again, over the last 19 years, November, we see steel outperform the S&P by 4.4 percentage points, 3.3 in December. So that's pretty significant outperformance, 7.7 over those 2 months. And it typically continues throughout the first quarter of the following year. So we're entering a stretch here on the steel stocks where we tend to perform pretty well on a relative basis and on an absolute basis. Let's take a look at the chart on steel, though. We've got the PPO moving lower, price action reversing a little bit today, but we're clearly in a downtrend. Let's take a look at the last year and see if we can find some support levels on steel. Well, if we keep dropping, we should find some support down around 235. I'm going to go back another year. Yeah, 235 was this level. Actually, down in the 220s would be tremendous support. So if we see the market continue to sell off, steel has been under a lot of selling pressure, but I would expect if it gets down to that 230 area, 220, just keep in mind that it is entering into a period historically where it outperforms, and it also will be hitting a pretty significant area of price support at the same time. So maybe it's a little early to get into steel, but continue to watch, especially if we go down there and we start to see a positive divergence form on these lows. All right, next up, let's take a look at, we're going to move into the industrials. This was the primary group that had performed so well. Let's take a look at the industrials, though. That was steel was the big one in the materials that I wanted to point out. Okay, let's go take a look at the DJUSBD. And first of all, that's just the last 5 years. But this is building materials and fixtures, by the way. And here you can see in November and December, significant outperformance by this group versus the XLI. Now, just like the XLB, the XLI outperforms in November and December, and this group outperforms the XLI. So clearly, this is a group that tends to significantly outperform the S&P 500. I won't keep going back and forth to the individual charts. We'll look at those in just a minute. But let me just keep going through the list here of other industry groups. Airlines. Erin mentioned earlier a few airlines got downgraded. Historically, they're about to be upgraded. I mean, October actually tends to be a pretty good month for airlines, not so much this year. But November and December both show pretty good outperformance versus the XLI. And if we pull it up again relative to the S&P 500, you will see that there has been significant outperformance in both November and December. So normally the fourth quarter pretty strong for the airlines. And this is a group that was actually starting to show a positive divergence on the daily chart. So this is one I definitely want to look at in just a second. But let's go into the commercial vehicles and trucks, DJUSHV versus the S&P 500. And you can see that last 5 years have been pretty strong, but the last 19 years have been very strong in both November and December. So this is a group you want to keep an eye on. DJUSFE. Don't think this one liked December as much. No, mostly November. It's outperformed the S&P 74% of the time over the last 20 years in November, and at the average is by 3.2 percentage points. So very strong group here. That's the industrial machinery space. And then the last one I wanted to mention is the DJUSHR, which, this is commercial vehicles. I think I do before. Let me pull that other one up. Yeah, the other one, the HV, is heavy construction. That was my bad. So the HV relative to the S&P, you can see very strong. This is heavy construction. The HR was commercial vehicles and trucks. My bad there. So DJUSHR, but look at this outperformance in November and December. It outperforms. It's not that it goes up by 6.5%. In these 2 months, if you add these two up, 4.3 and 2.2%, it outperforms the S&P 500 in November and December by an average of 6.5% over the last 19 years. So if we just get rid of that and just look for absolute performance, you will see that this group is one of the strongest. 8.6%. The group averages going up in November and December. And look at that November, 89% of the time, the DJUSHR has gone higher in the month of November. So this is a group I think we definitely want to take a look at. And it's a group that's been beaten up so badly. So let's take a look at this one first. Then I want to go back and look at the airlines. So here is the DJUSHR. Look at the dismal October performance that we've seen in this group. And we could go back. I'm going to go back a couple of years just to give you some perspective here on this decline. But we are now all the way back down to where we were back in May of 2017. So all of these gains that we saw, pretty substantial gains, 1,600 to 2,300 on the index, all gone, given back. But October does tend to be, November tends to be a very strong month. We'll see if we can bounce off of oversold levels in a very bullish historical month. And then the other one, I'll leave this 2-year chart up, but let's take a look at airlines. Okay, airlines coming down in the positive divergence I'm talking about. You see the low here, more than the double bottom. We actually hit new lows. MACD or PPO here actually is higher. I'm sure MACD is probably higher as well. But we've got a price positive divergence in terms of price. So the price goes lower, the PPO goes higher. Very similar, I would say, to September. Look at the selling here. And you see how we went down to this lower low and the PPO had actually turned higher. Look at what happened after that. So I'm not saying that that is going to happen, but I will say from a reward to risk standpoint, airlines look pretty good because we are at a major 2-year support level or close to it. The 240, 245 area has been very strong. We have bounced up to 256, but if we're just starting a move to the upside, we still could have a long way to go on the airlines. Okay, let's take a look at some individual stocks. And I'm going to focus on the NASDAQ 100. This group has been really beaten up. We do tend to see some pretty good performance in the NASDAQ 100 in November. First, let's go back to that seasonality for the NASDAQ 100, the NDX. The last 5 years, by the way, November has been up every year and averaging 1.7%. But if we go back over the last 20 years, we still average 1.6%. And notice November has had the highest odds of the NASDAQ 100 moving higher when you compare it to all the other calendar months. 74% of the time, 1.6% average return during the month of November. So we are dealing with an index that tends to go up. So what stocks within the NASDAQ 100 tend to be really strong? And I'm going to give you a handful of those. Some of them that I think are the best relative performers. Nvidia. And many of these stocks are going to be those growth stocks that have been beaten to shreds in October. But look at November and December for Nvidia. Averages going up 17% in these 2 months combined. That's a good return for an entire year. And that's what Nvidia has been averaging over the last 20 years just during these 2 months. And you can see 75 to 80% of the time, roughly, November and December move higher. So Nvidia's got a strong track record during the months of November and December. Autodesk. Autodesk, 8.4% average return in November, 3.8% in December. That's 12.2% that this stock averages gaining during these 2 upcoming months. HOLX, which I believe is Hologics. Well, last 5 years, you can see it's averaged going up almost 6%. Been up the last 5 years, all 5 years. Over the last 20 years, you can see Hologics has gone up 79% of the time, 79% of November's, and averaged going up 8.8%, which outside of January, November has been the best month of the year for Hologics. Qualcomm. Qualcomm, last 5 years, not so great in terms of odds of going higher, although returns haven't been bad. Over the last 20 years, though, goes up about 2/3 of the time in November, and 8.4% average return in November, 5.3% in December, 13.7% average return these 2 months, going back the last 20 years for Qualcomm. All right, Western Digital. WDC. Last 20 years, 5.3% in November, 5.6% in December. That's 10.9% average return for the last 20 years in just those 2 months. And then the last one I want to mention is REGN, Regeneron Pharmaceuticals. And here you can see average return in November, 6%. Average return in December, almost 11%. So that's almost 17% a year on REGN dating back the last 2 decades. Pretty strong. So where might you decide to stay away in these next 2 months? VRTX, Vertex Pharmaceuticals. November, actually December's not bad. November, though, average is going down 6.4% over the last 20 years. And you can see looking across the bottom here, just about every month is positive. For some reason, you get into this September, October, November period, and Vertex struggles. And then the last one I wanted to mention is Electronic Arts, which has posted average losses for every month in the 4th quarter. Think about how bullish the market tends to be October through December. And Electronic Arts, for whatever reason, starting in September, just not good to close out the calendar year. You go back and you look at the first 8 months of the year, and you see almost nothing but gains. Last 4 months of the year, Electronic Arts struggles. So if we take a look at that chart, I'll pull up a couple of these. But you've got a PPO that is still pointing down, getting a little bit of relief today. anything near the 20-day moving average, I would be cautious with EA. Let's take a look at Nvidia. Nvidia was the one that had has a great history November and December, but look at how it's entering the month of November. Literally a ski slope. 290 above 290 at the start of October, went down into the 170s yesterday before bouncing back nicely. Great recovery off the bottom. You just got to wonder after this bounce is over whether or not we move back down one more time. Let's take a look at REGN. Now, I'm looking for maybe a island cluster reversal. Off of a downtrend, we gap down, kind of trading sideways here. It'd be nice to see a gap up back above 350, maybe leave all of these candles on an island. Still would have a 20-day test to have to deal with, but I think from a longer-term perspective, if we pull out that weekly chart, this is a company that had been doing much better coming off the bottoms in May. If we could get back through that 20-day, we'd also be getting back up above the 50-week moving average. So I think that's something to keep an eye on. All right, HOLX, that was one I thought that was interesting. Let's pull up that chart, and then we'll take a look at the poll here and wrap things up on November seasonality. HOLX, I wanted to point out, look at the recent pullbacks and where this stock has found buyers. Right at about $37.75 to $38. Yesterday, it looked like we were breaking down, but we came back up, held the support area. Today, trying to break out, or not break out, but break back to the upside. If we lengthen this chart, all right, we lengthen this chart, you can see that this area down here around 36, short-term support's around 38, longer-term support, I would say, is down closer to 36. So as we weaken, knowing that this stock performed so well in in November and December, I'd be looking maybe for some sort of reversing candle or maybe a positive divergence on a 1-month chart. And actually, we're starting to get that. Here you can see lower price. The PPO has turned higher. I wouldn't be surprised to see this move go back through the 20-hour and maybe get back up to this 50. I think we have maybe another dollar in the short term to the upside on HOLX. And then maybe we come back down one more time. But I do think, given the historical tendencies, HOLX could provide us some opportunities as we look over the next 30 to 60 days. All right, that's pretty much what I had for the seasonality. So let's go ahead and pull up that summary slide, and then we'll take a look at the poll. But yeah, the monthly index ranking, as I went through and told you, this is a pretty good month. November and December tend to be very strong months for the market and all the major indices. And so if we can just find that bottom, maybe see the VIX and the VXN spike one more time to put in a definitive bottom in the market, that could be a very good sign given the historical tendencies that we have seen in November and December. Okay, we're going to go on to that poll. I want to see how many of you know what is the best S&P 500 month since 1950. Erin, did you have an answer?
I did, and I don't know if I'm right. I'm trying to remember because I know we've had this discussion and I know you've talked about it on the show. I said October because I think you had said that it's a misnomer that October's a bad month.
Well, in the last 20 years, you would be correct. Last 20 years, October has been the best. But since 1950, the last 7 decades almost, the number one month is not November. I thought maybe my clue from earlier would help everyone when I said November is not the best. It is December. December on the S&P, January on the NASDAQ.
Interesting. Yeah, December was my second choice. But like I said, I guess I'm remembering when you've discussed the last 20 years. I just remember the question and the answer. It was not what we thought because everybody thinks October is so terrible. And then in actuality, it really isn't.
No, it really isn't. Well, it was this year, and it has been.
That's true.
Yeah, we remember 1987 and we remember 1929. I mean, certainly pretty bad those months, but those years. But for the most part, October is a pretty bullish month. But the other thing we got to keep in mind is the last bear market, 2007 to 2009, it began in October. We topped. Our final high was October 10th, 2007. So it's not unprecedented that a bear market could start in the month of October, even though fourth quarter tends to be very bullish for equities.
Yeah, sure thing.
So, but I went back and compared the S&P versus the NASDAQ since 1971, because the NASDAQ, that index was created back in 71. Just to give you an idea of some of the differences, because you might think, well, if the NASDAQ does this, then the S&P does it. That's not necessarily the case. Going back and using the same data since 1971, the month of December is pretty strong for both NASDAQ and the S&P. The S&P, like I said, it is the best month since 1950. It's also the best month since 1971, rising 18.77%, whereas the NASDAQ has risen 23.44%. But a big disparity is in January, where the NASDAQ over the last 47 years has averaged going up. Well, should not average. It has an annualized return, average annualized return of 31.72% during the month of January. So that doesn't mean that the NASDAQ goes up 31% in January. I'm not trying to say that. You would have to take that 31.72 and divide it by 12 to come up roughly with the average return, which would be about 2.6%, something like that. So that's what the NASDAQ has averaged going up since 1971, about 2.6% in actual absolute returns. But the average annualized return, 31.72%. On the S&P, it's only 12.91%. And if there was one thing that surprised me here on this poll, was that January only got 6%. I would have thought more folks would have thought January was our best month of the year, but they're smarter than I thought. Everyone's so smart.
Of course. No, they listen to you all the time and they know.
I guess. I don't know.
I think so.
Yeah, I guess everybody was listening back in January when we were talking. I probably did.
Exactly. Every month we listen.
All right, ready for the 10 and 10?
I am ready for the 10 and 10. Hopefully you are ready for the 10 and 10. Here's the RRG setup here. What I found interesting is that everything was pretty much in the same window. We didn't have any major outliers. I mean, obviously there are a few, but there weren't sometimes we have them coming way out, and we didn't this time. The other very interesting thing about our requests, look at all the industrials. I don't think I've ever seen this many industrials requested by our viewers, so I think that's pretty interesting. Seeing consumer discretionary up there is not a surprise, but industrials, I think so. So anyway, let's get started with Target, and everybody vote, because right now there is a tie in the chat room for what is going to be the next symbol. So get in there and vote.
All right, Target. I just want to point out a couple things here. You know, I've talked about stocks when they're below the 20-day moving average, kind of watch to get them through the 20-day, and how I like to see volume. And I just was looking back on Target's chart, and I thought there was a couple of things that I could point out and kind of show you what I'm referring to. Here, Target had a huge move up, pulled back, established a very important low, moved back up. You can see failed to break out. And this is why when a stock is moving up and it's getting close to resistance and you're starting to feel really good, from a trading perspective, I take the money. And you can see why in this example. You go right back down to that support area. Now, maybe we break out, but here we had a reversing candle, bearish engulfing candle right at the top, and continue to move lower. But notice here, we move below the 20-day. We come back up. We test it a couple times, can't get through. Keep moving down, hit the support level, and then we bounce. Now, when we made this break above the 20-day in early April, check out the volume. There was almost no volume. Volume had dried up compared to almost every one of these prior moves. The volume was very, very light. And as we went through the 20-day again later in April, the volume was even lighter. There was no commitment to these moves to the upside. Went back down, hit the price support level, and then when we made the breakout through the 20, check out the volume pick up. That to me is a much more tradable kind of a breakout. Now, we did come back down temporarily below the 20, but that first move up did begin a very significant rally in Target for quite some time. So here's our move up, similar to the move up we had back at the end of 2017, early 2018. And now we're starting to consolidate. We're moving back, probably maybe establishing a low. I mean, I don't know if this one did it or not, But I'm a little concerned because we're getting back through the 20-day. And so far, we have to see how the volume does by the end of the day. But so far today on this move through the 20-day, it's going to be, and actually maybe the volume has picked up a little bit, but it looks like it's going to be on the moderate to light side. I'd like to see more volume. I'd feel better about this move through the 20-day if the volume is strong. So we'll want to watch that. But if we get back up, I just put this red dotted line in here as an area where we might struggle. You can see the last two rallies failed, those long tails up near 87.50. So target to me, I would be a little nervous if if the volume doesn't pick up and we see some sort of a reversal near that 87.50 area. Overall, though, I got to say I like this long-term chart on target. It's been outperforming. I mean, when you're sitting $3, $4 from the recent high with what we've been through in the month of October, I think that says a lot about Target's relative performance. So I do like the stock. It's just I don't want to just sit here while it consolidates and wait for it to make a move. So watch those levels. I think we have a chance, especially if the market's weak, maybe going back down just around that 80 level. We'll see.
All right. Let's see here. The most popular in the chat room, and it's a good thing it was because we just looked at it, I think, yesterday. Walmart, WMT, sort of in the same vein a little bit, actually.
Yeah, I love this breakout today on Walmart. I was looking for a test. Yesterday's candle, I would not have expected the stock to move higher again today. I would have been expecting maybe a pullback to that 20-day moving average. And what I'm referring to, you see that long tail yesterday above that, and I probably would have been a seller as we got up to 100 anyway, expecting a pullback. But we are actually trying to make a breakout today. And if this holds, I think the next stop is going to be back up at that January high, close to 108. So I think that this is a beautiful move up, nice little rounded cup. Pull back to put in a handle would have been nice. But still, I'm not going to argue with the breakout. It's on pace right now, probably to do over 10 million shares, which when you look back is pretty decent volume. So if it can hold above 100 here, I like it.
All right. I'll go ahead and we'll pick the next one that was the most popular. How about Disney, DIS?
Yeah, Disney on a relative basis has been a very nice performer. It did have a false breakout just recently, but the uptrend remains in play. So I'm just looking at these last few lows. But if we go back to where this run really began, which was back somewhere around late May, early June, and connect those lows, I think that's pretty nice little trend line support. And so what you're looking for to the upside is to move back up to 119. To the downside, I'm going to say these recent lows around 111. I think if you lose that, you're losing some pretty big short-term support, and you're also losing that trend line. So I'd trade this with a range between 111 and 119.
Okay. The next one I have for you is from the technology sector, Electro Scientific Industries, ESIO.
MKSI bought them today. MKS Instruments. So technically, and I haven't looked at the deal. I don't know if it's a cat. Must be a stock deal because it's continuing to move higher, which tells me it's probably trading with MKSI. But I'd have to look at the MKSI chart because we're getting a breakout here in the stock. But yeah, I mean, it's up 92%. And it's probably going to trade somewhat in line with MKSI going forward. But, technically, I don't know if you can really use this on a buyout in a 92% move. But it is at least nice to see it clearing that double top that we had back in late 2017, early 2018.
All right. The next one I'm going to give you is Goldfields Limited, a gold mining stock, GFI.
Yeah, I'm thinking gold may have topped. We had a couple failures at 1240, a couple tails going up, I think 2 or 3, and we've rolled back over. I'm looking to see if the gold GLD can hold on to its 20-day moving average. If it cannot, I would be really careful. I think this stock made its way all the way back up to a very key resistance level at $3 and is beginning to roll back over again. It's been below its 20-day moving average on the close the last 2 days, which really shouldn't happen when you have a PPO that was strengthening like that. Volume was picking up on the selling. I don't like it. I I'd need to see a reversal back up above that 20-day before I could even begin to think bullishly here.
Okay, this person has been very persistent in their requests for the China Bear 3 times fund, and that is Yang, Y-A-N-G.
All right. Well, I mean, obviously it's performing well. I haven't gone, it would take too much time to go back and figure out whether or not you're really performing at 3 times what the loss has been in China. The China market's been very weak, one of the weakest in the world, if not the weakest, certainly one of them. And as a result, you can see Yang continuing to move higher. I don't know if it's the Shanghai that this follows, but I always talk about wanting to see what's going on in the underlying index when you play these leveraged ETFs. So I don't like to technically try to figure out what's going on, because sometimes you get breakouts on the ETF, the leveraged ETF, when you're not getting a breakdown on the underlying index. And that can be a really significant false signal. So what I'm going to do is I'm going to annotate the SSEC. We continue to move lower, very, very weak. We could probably go back, and I'm going to do this on a weekly chart and look at the last few years. But yeah, I mean, and I think Martin Pring might have mentioned this, but this was a pretty key support area from 2016 that broke down. And, I suspect with all the weakness that it's probably going to continue. But if you look at this weekly chart and follow that 20-week EMA, I mean, every time you get a test or you approach it, that is the time to be getting into that short ETF. Because if it breaks through the 20-week, I would be getting out of that juiced ETF. I short term, if I'm going to trade any of those leveraged ETFs, it's very short term. I'm not trying to hold them long term. They do lose, they lose some of their value just over time. They erode over time, not really following the price action, just simply the way that they are, using derivatives and so forth, the way that they're priced, they do lose value over time. So what I would just suggest is if you're doing the short ETF, that leveraged ETF, follow what's going on in China, the underlying index, which I'm assuming is the Shanghai. I might have the wrong index. But the action there has been very bearish. Until it gets back through the 20-week, I think you probably have a pretty good trade there.
All right. Next one, let's look at Glu Mobile, GLUU.
All right, nice gap up. I'm assuming that's earnings related. I don't know that for a fact, but it did gap up and clear the 20-day, and so far it is holding it. So from a short-term trading perspective, as long as I stay above that 20, especially on a closing basis, I'm okay. If it fails, though, you could go back and fill this gap. So the levels that I'm watching on GLUU, first of all, that's going to be your major gap support level. You gapped up, went below the 20, but you held it on the close. And so far, you are trading above that 20. Again, I think if you go below it, you're really running the risk of going back down to test this gap support level.
Okay. Next one I have is Coca-Cola European, CCE.
All right, pretty nice pattern. It looks to me like maybe a little symmetrical triangle after an uptrend. So if we, first of all, just identify that uptrend, which is pretty clear, I think. And then from there, when I see a stock begin to consolidate, I start to look for patterns. It's in an uptrend. I expect that uptrend to continue. So what might we be seeing in terms of pattern development? And right now you can see that the lows are getting higher, the highs are getting lower, and we're squeezing in this triangle pattern. So my guess is we probably are going to hold below this 45.5 area, and maybe make another run back down toward the 43.25, 43.5. But I would be watching this pattern develop. I do like the volume trends. I think this one goes higher, but I'd need to see a breakout above 45.50 and clear this symmetrical triangle.
All right, here's one I wish I had shorted. FLIR Systems, FLIR.
Yeah, that would be a nice short. Sure. let's take a look. I'm going to do one on a relative chart because it's been really weak of late. Oh, it's in defense. Yeah, that makes sense. I mean, defense stocks have been getting absolutely crushed. Here is the defense index. So 475 to start the month, 390 at yesterday's low. There's a lot of sellers in this space, number one. Now, I think I saw earnings on FLIR yesterday. I just kind of remember seeing it going through all the news. And I'm guessing with this kind of volume, that's probably what happened. They probably missed. As far as the volume goes, you look back over the support goes, you look back over the last year, and I think 45, 46 is big support. And we are testing it with massive volume today. So this is an area that I would be watching to see if it holds. With that kind of volume, if it goes through this support, I would certainly not want to be in it.
All right. And let's see, our last one, let's make it FedEx, FDX.
Yeah, I think delivery services was one of the areas of the market that does pretty well, either November or December, but it didn't quite make my list. So FedEx, when you look at this, the air freight right here, this industry, I might have it in my notes. Hold on one second.
Yeah, for me, the PMO is getting ready to turn up. At this point, it's decelerated. So kind of interesting, kind of interesting.
Yeah, I mean, they've been selling off so hard, so many areas that probably even as they it's going to, all those momentum oscillators are going to start to turn up pretty soon just because it's going to be hard to keep this pace of selling going forward. But I don't like losing the support level from back in November. You can see the group had broken to a new low, and on a relative basis, FedEx has been downtrending versus its peers, versus the S&P, and the group has been downtrending versus the S&P. So there's just really nothing here that excites me if you're looking for outperformance, other than maybe a quick little bounce. And if we do bounce, I'd be looking maybe at 220 to 225, and we'll see what FedEx is, what it's got left in it when it gets up to that level.
What it's made of. All right. Well, that concludes the 10 and 10 to 1. And you should be seeing right now all of the stocks that we just went over. I will have those up in the Market Watchers Live chart list. All you have to do is go to the blogs tab on our website and then click on the Market Watchers Live blog, and all those charts with the annotations will be there for you to look at, save, whatever you'd like to do with them. All right, time for our final market update. I can't believe the show is almost coming to a close. All right, here we go. What's been going on? Well, we have had we are on the positive side. We started okay this morning, but we're starting to pull back, and that does concern me. It looked like we were going to have a nice move to the upside, and now we're starting to see rounded tops. NASDAQ also starting to fall. OEX is up only slightly right now. Mid caps and small caps still look okay. They are still in a rising trend despite this pullback right now. And TSX is falling, also opening higher and then falling. Treasury yields are now starting to fall a bit. We're now at 3.098%. UUP, a small gap up and continuing higher, making new intraday highs. Currently, UUP is reading at 25.81, just above that. GLD, a little bit of a gap down, and it is trending downward. So we're starting to see a little bit more of that reverse correlation between the dollar and gold pick up here a little bit. TLT bonds, big gap down, but starting to pick up, got back made up about half those losses, but it is still down almost 30 cents, reading 114.44, and USO down almost a full percentage point right now, reading at 13.98. And that's all I have for our final market update. Tom, and pass back to you. I know you always have a good chart to look at.
Yeah, I'm going to post or put a chart up here that I had in my blog this morning. And I think, when you're looking for, when are we out of the woods? First of all, trying to call bottom. And I really thought we might have had a bottom on Friday. And then yesterday we just go right through those lows. and continue with a high volatility reading. And so it's difficult to try to catch a bottom. But one thing that, in addition to the number of points that are lost in a market decline, we need to see the rotation. And when you're in a decline, it's very normal for money to rotate towards defense. But when you start to move higher, when you come off a bottom and money begins to rotate back to riskier areas, we should see these downtrends break. So first, this is going back really over the last few months, but since October, you can see the S&P 500 still in this decline. Then we take a look at the XLY XLP, which has been struggling down to about 188. I think previously I said 175 to 180. I wouldn't be shocked if we went down as low as that. We're certainly heading there pretty quickly, but we need to see this reverse back up. Then you look at the XLRE versus the S&P 500. This is real estate relative to the S&P, and look at the move in terms of relative strength for real estate and consumer staples and utilities. So all of these relative uptrends on defensive areas and the downtrend in the S&P 500, the downtrend in the XLY versus XLP, if you want a healthy market, every one of these has to reverse. And so we're not yet seeing that. And with the volatility index, the VIX and the VXN as high as they are, it's still possible we could have another, round of impulsive selling to the downside. So just got to be careful out there right now. But anyway, time for a scooter report. Erin, take it away.
All right. Yes, let's take a look. So what I thought I would do is give everybody sort of an idea of how you can use the scooters. There are different ways to go about it. So I thought I would go through a few different ways, and we will look at a few stocks as well along the way. But first, I want to start off with just the definition of the scooter. That is our StockCharts Technical Rank, and I know we use that, the scooter name all the time, and forgetting that not everybody understands what that is. But this is our very own indicator, and it was a methodology for it, as you can see, came from John Murphy, and really, the calculation is weighted a lot more to the long-term and medium-term indicators. Just something to pay attention to. Look at short-term indicators. The weighting is only 10% total of the scooter rank. So what you're seeing there is not just kind of the short-term strength going on when you get that scooter moving quickly, but you're also, when you get those higher ranks, it's telling you that internally, not only relatively, but internally, it's strong in the longer term and medium term. So let's go ahead and look at a few different ways to go about this. So I'm going to start on the home page. And what I'm going to actually do is start here. I want to look at the sector summary because I want to see what areas I want to be interested in looking for as far as the scooter. So I'm going to look at the last 3 months and see which sectors have been performing the best. And unfortunately, as we all know, the defensive sectors are what have been leading the market over the past month to 3 months. So what I think I'm going to do is go ahead and look for scooter values and stocks based on their scooter from the consumer staples area. So let's go back to the beginning and go to the scooter reports, and you'll find those under reports and analysis tools, just like that sector summary I just showed you. And let's go to our scooter report. I'm going to say 1,000 entries because I want a lot of choices here when I go through that particular sector. So I wanted consumer staples. So I'm going to search that table to get the consumer staples sector only. And what I like to do, and I know, Tom, you do it frequently as well, is looking for sort of those up and coming, that they have some strength already, but they're not quite in that hot zone yet. They haven't gotten above 75. They're making their moving to the upside. And so I thought I would look at some of these in the 70s and 60s. And I think I had picked a few of these. I know we've looked at Mondelez International, but I'm going to pull that one up anyway because I want to show you the scooter and how it has been moving. So you can see one thing to maybe think about when you're looking at the scooter is since the top here of October, it's been trending upwards. Interestingly, while the OBV and the PMO have been moving lower. So in the shorter term, there are clearly some issues when you look at what has been going on with the PMO and the OBV. But the scooter is telling you that in the longer term, intermediate term, there's some good things going on here, and it's worth your look. So that was one that I thought was interesting. And like I said, I know we've talked about the support and resistance. We've looked at a bunch of charts with Mondelez. So I'm going to move on. Let's see, ADM was one I was looking at earlier, Archer Daniels. And this has a scooter of 73, and again, in that consumer staples area. All righty. Not the best looking chart. I mean, as far as decision point goes, you do have the scooter, and though it's in that 70s range, it's really not done much. It's pretty much just been in that sort of just slightly above average area. Meanwhile, the PMO has been falling. We got the bounce off of the 200-day EMA, but I am a little concerned about that 2050 negative crossover. But this was another one I thought was interesting in the staples area that you can find using that scooter report. And I think CVS was the other one I think is really interesting right now. And it's been in the hot zone. It did pull back out of it, but it's trying to make its way back up into it. And the PMO is starting to decelerate. It was already sort of slowing itself down here. And so I thought that was very interesting as far as looking at the scooter and, again, the OBV. The OBV is kind of flat, but we're seeing the scooter starting to make a little bit of an improvement here. Now, again, as far as my trading goes, this is not necessarily what I would look for, but I think it would be due to sit in a watch list just to see if that PMO can make that turn to the upside here. So that one CVS I thought looked fairly interesting. So now let's look at a different way to go about this to find scooters. And honestly, this is the way that I tend to use the scooters more so than the scooter report, but I did want to show you how you could use it. And part of the reason is I just love my candle glance. It just gives me so much help in figuring out what I want to do. And the easiest and quickest way to get a candle glance of what's going on with our big scooter movers is just come to the main menu. And then any of these tiles, of course, you can make whatever you want. For example, there's the scooter ones right there I have, but I'm going to put it up here just so it's easier to see and show you how you can get them. So you get the top 10. You can see who the big leaders have been so far as scooter ranking that are sitting right near the top. And a lot of times these, excuse me, will sit here for quite a while. So it's always interesting to see how they make their moves to the up and down. But it's also interesting to note that these are the ones that are showing the most strength. And so that might be something you want to consider when you're looking at possible entries. And again, here's where you can do some damage. Here's where you could really get some information. And that, to me, is using that candle glance and the RRG. And you can just very quickly do that. And for me, I have my own candle glance set up. And so I get to see the indicators I want on my candle glance. Now, you can do the exact same thing. All you have to do is set up a chart the exact way you'd like to see it in a candle glance, and then save that chart style as candle glance. And then forever and always, until you change it, you get your candle glance when you pull up a candle glance selection to look at them. I'm going to make this a little bit bigger here. Here we go. So what I'm looking for, right, when I do as far as decision point, I really depend a lot on my PMO. I trust it, been using it for a long time. So what I want to look for are, these were the top. So I want to see some that maybe haven't made the big move or are making a breakout, like we're seeing here with a PMO buy signal. That is interesting to me. So I'm going to look at Welltower, WELL. And we've got a nice breakout here above 68, which we saw back in the August-September timeframe as the top. This is in the REITs area, which is, we know, sector-wise has been stronger. And while the market is, uncertain, this is probably an area that will continue to do better than others. I like this breakout. I got the PMO buy signal. And honestly, right, if we had gotten involved in this after that buy signal, we'd have been able to ride a lot more of this rally. But that's okay. I was finding it from the scooters, the top scooters. So, I wasn't doing a scan, so I didn't happen to find it. But I think this is interesting. We've got a nice breakout. I'd watch to see if we can get a pullback to that breakout point. And then that's where I would be interested in making an entry. So let's go back to that nice candle glance. And I'm going to move to a different one, but I'll just say that one looks fairly, Nordstrom we already looked at today, interestingly enough, right? Red hat, big move up. I wouldn't get involved with that. Under Armour, again, big gap up. These are good charts. They've got a decent PMO, but the problem is they've already made those huge runs. And that is sometimes what you're going to find when you look at those top 10. So let's try a little different approach. Let's look at the top up and top down. And what these are, they're telling you the biggest moves to the upside and the biggest moves to the downside as far as the scooters are concerned. So I'm, of course, most interested in the ones that are making a move toward the upside on their scooters. And again, there are two ways to do this. You can look at the RRG of these and get an idea of which ones that you think look better based on the RRG. I'm seeing two here, TLK and FL, that look very interesting. So I'll probably see what they look like as far as the candle glance. All right. TLK. All right, we have a bull kiss on TLK. So that's rather interesting to see that with the PMO. I can see right here with this rather choppy trading, this is not going to be one I'm interested in. I suspect it's low volume. The other one that was interesting, right, was Foot Locker, and looking at the RRG. And this one I think is, I can see why it's making the move. I can see where the scooter's making the move. I can understand why maybe the RRG is improving here. But with a stock that's been moving mostly sideways in a sector, I'm not really excited about seeing something where you're getting such consolidation. If you want to play the top and bottom of a trading range, you certainly could do that. But I'm looking for something with a bit more potential. But that was interesting, right? The RRG looked really good for that. Let's see, another one here. Hanes Brands looks very interesting because I do have this rounded PMO bottom and now a buy signal. There's that scooter move, which is why we're looking at this, because of that, looking at it from the front page. Look at the nice breakout here on, this trading range has held up in the short term, and now we got the breakout. And it's broken above that 1750 level. I'd like to see it close above that because you can see that's been an area that was previous support. So I'd like to see that broken through. But I like the way this is setting up. You've got the 5-day EMA about ready to cross above the 20. And it seems to be doing fairly well as far as that PMO, like I said. So this one I find very interesting, and that would be another way to go about finding interesting stocks. So let's say it's a bad market. Maybe I'm interested in shorting. You can do the same thing by doing the top down. Get a candle glance up there and boom. And now you can look at the PMO in the opposite direction. Which ones have an interesting look based on what the PMO is doing and based on where price is sitting as far as shorts. So right here, you can see it's sitting on support. Want to look for that breakdown. So with Ulta, you can see we have that top below the signal line on the PMO, and it is sitting at this support level. So if you're looking for a short, that's what you're looking for, something that looks like it's ready to break down. So Anyway, that pretty much concludes what I was going to show on the scooter report. And we did look at a few symbols. Here is the summary of what we just did here. Let's see. All righty. There we go. All right, so we looked at a couple of different ways to use the scooters. And of course, we've started in chart school for the definition. You can go into the scooter report itself, remember, from the home page on that left-hand side where you have your reports listed in that tile. And then we looked at a few interesting ones that were mid-range. And then the scooter movers, using that, and then clicking on RRG or candle glance, and then using your own setup to review what's moving right now and what could be interesting to the upside or the downside. So I'm going to conclude that. Tom, can you believe it? It's already time to close out a show.
It is, and I'd looked at some of those stocks that were moving in terms of scooters, and Akamai was on that list. Of course, they reported earnings and a new 1.1 billion share repurchase agreement. Hedrick and Struggles, HSII, I think that's a recruiting firm, also did the same thing. And I'm just looking at the chart on HSII, but the stock's up 29%, off of a downtrend. I mean, stock had been going down from $44 beginning of September all the way down to $29 before their earnings report came out. And I find it kind of interesting because they blew away top and bottom line. 192.3 million revenue versus 175.8. So that's not even close. That was a 10% beat. And then bottom line, 85 cents versus 50. And so, yeah, pretty, and considering the chart is absolutely, falling apart, just kind of strange.
Hey, I forgot to ask you a question that people had in the chat room about your seasonality. Basically, have you taken into account midterm elections? Like, is that something that you've looked at or not?
No, I mean, there are some who look at election, the different elections and the cycles with the elections, and third year of a first term president, third year of a second term president. I mean,
right,
a lot of different possibilities. And the problem I have is that the sample isn't that large. I mean, even if we go back over the last 70 years, I mean, how many different presidential cycles have we had? And is that enough data to, make some kind of a forecast going forward? I don't know.
No, I kind of see what you're saying. Yeah, and I know that the CMT, there's plenty of studies about the presidential cycle, and yes, and I couldn't tell you what it is because I had it memorized for the test, and now I've promptly forgotten. But yeah, there's some interesting data there, but I think it's more interesting than useful or actionable.
Yeah. And I'm a big fan of statistics and mathematics, and I've certainly torn the market apart a number of different times. But I do want to see a representative sample. I mean, when I go back and I quote some of these historical stats, I'm going back and looking at every day on the S&P 500 since 1950. That's a lot of data.
Yes.
To come up with trends and so forth. So I do think that matters. You want to make sure that you have a representative sample.
Right, just like sliding the slider over to the left when you look at those seasonality charts.
Yep, absolutely. All right, well, looking at the schedule coming up, we do have Dr. Alexander Elder coming in tomorrow for Halloween. That'll be a fun show for sure. Erin will give you the latest on the Decision Point Monthly Review, and then Mary Ellen will join us on Friday for the What's Hot, What's Not. I want to thank all of you for being with us today. We'd love to get your feedback, so please complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Be careful out there, and we'll see you back here tomorrow. Happy trading.